2% in a sustained way.
All right, let's get some opinion in, and this is interesting opinion as always. Jahangir Aziz is head of emerging markets, economics research and commodities at JPMorgan, and Dean Kim is head of global research product at William O'Neill. Great to have both of you here. Thanks very much. Jahangir, what did you make of the decision last night? And more importantly, I mean, the market reaction to it. The fact that the dollar was actually down on the day when the Fed was nothing but as hawkish as it could be in the current context.
Look, I think the dollar has been down, and market has essentially been saying that, look, regardless of what the Fed says, when the recession hits, the Fed will be forced to cut, right? And you heard what Chairman Powell said. I mean, that they are not even thinking about rate cuts in 2023 because they're nowhere close to even pausing or even deciding how long the pause will be. So my sense is that as this reality sort of seeps into the market in the next few months, or maybe even sooner, I think you will see the 10-year again test 4% or even higher, and dollar strength will be back. I think this is simply the market reacting to the 2 inflation print and saying, look, inflation is over, and even if there is a recession, the Fed will have to cut when the recession hits them. The Fed cannot pause till it goes and finds out that the inflation is headed towards that sustained 2% level.
Okay. Well, Dean Kim is also with us. Dean, is there more pain for global markets as the Fed decides to keep rates higher for longer?
Well, I mean, it's been very interesting couple of days. We're starting to see, inflation numbers coming in a little bit cooler. So yesterday, November CPI number came in cooler, and so the market reacted positively. Of course, today, the Fed came out with a higher dot plot, which will peak at 5.1%. So I suspect, there's going to be some volatility in the near future. But what's interesting from my point of view is that if you look at the short-term 2-year bond yield, it is now declining below the Fed funds target rate. Today it was around 4.2% versus a peak of 4.7 in November, and certainly much lower than the Fed peak forward curve rate at 5.1. So what the bond market is telling us is that the Fed continues to be behind the curve. And all throughout this year, the 2-year bond yield was much higher than Fed policy rate, and now it is reversing and going lower. So this means that the Fed may be overshooting, and we may see faster pivoting than what the dot plot is suggesting. But I think in the meantime, we're going to see some volatility. The market is finding it very difficult to reclaim the 200-day moving average, like on the S&P and the NASDAQ. So until the market kind of breaks above the 200-day moving average, I think we're in the camp of volatility.
All right. Hi, Dean. Good morning. Dean, what about India? I recall, when we chatted the last time, you said that Indian markets are looking a little bit toppish, and maybe taking some money off the table would not be such a bad thing. What's your view now?
Yeah, I mean, it continues to be very constructive. I mean, it's the best performing market in emerging market, let alone globally. And what we're seeing is the Sensex index finding nice support at around 21-day moving average. Came off the highs, but on low volume, which we think is very constructive. So the next support is 21-day moving average, which is only 1% away. And if you do see a bounce there, I would say, the market would continue to be in confirmed uptrend. Right now, we're seeing a lot of stocks breaking out early stage basis. So nothing's really changed from last time I came out and spoke. Indian market continues to be, very desirable globally, actually.
Jahangir, just to go back to that point that you made, right? That the market will reprice higher. I mean, dollar and yields, etc. Is it possible that I think it's widely acknowledged, and you would agree that Fed was behind the curve in terms of raising rates and then they had to do all of this very, very quickly. In a way, the market is now saying that they're behind the curve in pausing, or not cutting, but pausing. I mean, they're going too far. And, you know, is it possible?
Look, anything is possible. But so far, what is the evidence we have on the ground? If you look at the part of CPI basket that Powell keeps going back to, which is the non-rental services, which is about 55% of US basket, that basket hasn't really shown any signs of cooling off, right? I think the pace has come down, but it's still very strong, as Powell himself mentioned. And that's the part of the CPI basket that is directly linked to the labor market, which again has showed no real signs of going anywhere close to where the Fed would find it comfortable. So my sense is that, look, you know, anything is possible. You know, economists do almost all the time do not, you know, underappreciate the pace at which things change. That is not uncommon. I'm sure that this time around, when we look back at this episode, you know, a few years down the road, we'll say, yeah, I mean, this pace was underappreciated, both the up and the down. But right now, given the data flow that you have, I mean, you had a non-farm payroll that beat expectations 2 straight months. You had wage growth above expectations, and I think that the fact that that CPI inflation is coming down is fine and it is welcome. But the point still remains: the part of CPI inflation, the 55% of wage, which is the non-rental part, that still hasn't showing any signs of cracking.
Yeah. The bigger problem, Jahangir, for equities is always growth, right? How much will all of this action hurt growth? So after yesterday and what we've heard, and if they stay the course, does it kind of confirm that, you know, the growth will come off, I mean, even at a sharper pace in the US, and that is by far the largest economy with effects around the world?
I think if the pace of growth comes up at a sharper pace, I think you'll get relief from the Fed. So, but I don't think that the pace of growth is coming off at a faster pace. I think we are still looking at a recession somewhere down in 2023, and that goes into 24, but it's going to be a shallow recession. But I think what is interesting is not so much that the US economy is going to slow in the second half of the year, but that is also going to be the time, given the faster reopening in China, that the Chinese growth is going to pick up at that point in time. So I think what has happened is that global growth is not going to lose both its engines at the same time. Okay. And I think that's the more important point about emerging market asset pricing, that when the Fed is going to when the US is going to lose steam, that's exactly when the Chinese economy is going to pick up, which is what we think is going to happen in the second half of the year after all of this reopening volatility goes by. And so I think from a growth perspective, I think that the global economy, you know, China and US together, is going to provide some sort of support and comfort to emerging markets. Okay. Now it depends. Are you an emerging market tied more to the US cycle, or are you an emerging market tied more to the China cycle?
Okay. Well, it's always good, right? Whatever benefits emerging markets is good for our viewers and investors back home. But since we're talking about India and emerging markets, Jahangir, just leave us with your view on what the RBI will do from here on. Because do you think that the November CPI data is perhaps a game changer for the RBI, given that this decline in inflation could give some breathing space to the MPC in its fight against inflation?
I think the RBI has more or less shown its hand, just like every other Asian emerging market country has shown its hands, that they are, in fact, some of the emerging market Asian economies like Indonesia, in fact, stepped down even before the Fed did. So I'm sure that the RBI will follow suit and will step down. And, you know, this is also going to be the case for other emerging market countries, especially in the first quarter of 23, where I think you will see disinflation across emerging market taking place. But if you look at what are the macro vulnerabilities that India face, India still has a 3.5 to 4% current account. India has a fiscal deficit of 10.5 to 11%. Inflation, even if it comes down, it's going to be around 6%. And the 10-year rate is at what, 7? That is not compensation for the macro risk that India or countries like India among emerging market countries that is not a compensation for that risk.
Okay, we'll leave it at that. Dean and Jahangir, thanks a lot for giving us your quick take on what to expect going ahead from both the Fed and the RBI and the implications it would have on our own markets. Let's slip into a quick break. Our entire team will be with us to tell us what to expect in terms of individual stocks as we come back after a break.